The stock market. It's where fortunes are made, and sometimes where they disappear overnight. But what actually happens when people say the market went up or stocks crashed? Most of us hear about it every day, on the news, in headlines, or through that friend who claims to trade stocks. Yet few truly understand what this mysterious machine is and how it shapes our money, our jobs, and even our future. In this episode, we're breaking it all down, clearly, calmly, and factually. No hype, no jargon, just the truth behind how the stock market really works. Section 1. What the stock market actually is. Imagine walking into a giant digital marketplace, not for goods or groceries, but for ownership. That's the stock market. Every stock represents a small piece of a company, a share of ownership. If you buy a share of Apple, Tesla, or Coca-Cola, you literally own a fraction of that business. You don't get to sit in the CEO's chair, but you do own part of the company's success and its risk. The stock market is simply the system where those shares are bought and sold. And just like any market, prices are driven by supply and demand. If more people want to buy a stock than sell it, the price rises. If more people want to sell than buy, the price falls. That's it. No mystery, no magic, just millions of people agreeing or disagreeing on what a company is worth. Section 2. How companies enter the market. Before a company can be traded publicly, it must go public. That process is called an IPO, Initial Public Offering. Here's how it works. A private company, say a fast-growing tech startup, wants to raise a large amount of money to expand. Instead of borrowing from a bank, it sells ownership to the public. Investment banks like Goldman Sachs or Morgan Stanley help determine the company's value and set an initial stock price. Then, everyday investors, people like you, can buy in. The IPO is the company's first appearance in the public marketplace. After that, its stock trades freely, and its price changes every second as people buy and sell. From that moment on, the company doesn't directly control its stock price. The market does, through confidence, performance, and emotion. Section 3. Why stock prices move. Stock prices change constantly, sometimes by pennies, sometimes by billions in market value. But why? It comes down to three main forces: performance, sentiment, and events. Performance is the logical side. When a company grows its revenue, launches a hit product, or reports strong profits, investors see value and demand rises. The stock price follows. Sentiment is the emotional side. Maybe a CEO gives an inspiring interview or a viral rumor spreads on social media. Suddenly, investors feel more confident or terrified. And then there are external events. Inflation, interest rate hikes, global conflicts, pandemics, all ripple through the market. Even great companies can fall when fear dominates. So while it looks chaotic, stock prices are really just reflections of human behavior: belief, fear, optimism, and greed, all happening in real time. Section 4. Types of stocks. Knowing what you own. Not all stocks are created equal. There are two main types: common and preferred. Common stock gives you voting rights and sometimes dividends, regular payments of a company's profits. Most investors own this type. Preferred stock, on the other hand, doesn't give you a vote, but it usually offers higher, more stable dividends and priority if the company fails. Beyond that, stocks are often labeled by size and stability. Blue chip stocks, giants like Apple, Microsoft, and Johnson & Johnson. Reliable, long-standing, often paying consistent dividends. Growth stocks, fast-expanding companies like Tesla or Nvidia, reinvesting profits to grow instead of paying dividends. Penny stocks, small, risky, often under $5. Huge potential upside, but far more likely to fail. Understanding what kind of stock you own is crucial because not every company plays the same game. Section 5. How investors make money. There are only two main ways to make money from stocks: capital gains and dividends. Capital gains happen when the price of your stock goes up and you sell it for a profit. Buy at $100, sell at $150. That $50 difference is your gain. Simple, but risky, because the opposite can happen too. Dividends, meanwhile, are payments from the company's profits, usually sent every quarter. If you hold shares of a company like Coca-Cola or Procter & Gamble, you'll receive small but regular cash payouts, whether the stock price rises or not. Some investors even build portfolios designed purely around dividend income, using it like a paycheck in retirement. Section 6. Trading vs. investing. Here's where many beginners get lost. trading is not the same as investing. Trading means buying and selling stocks frequently, sometimes within hours, to profit from price swings. It looks exciting, but it's risky. Most traders lose money long-term because timing the market is nearly impossible. Investing, on the other hand, is about ownership and patience. You buy into strong businesses and let time do the work. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." And history backs him up. The S&P 500, which tracks 500 major U.S. companies, has returned an average of 7 to 10% per year after inflation over the last century. That's not luck. That's the compounding power of ownership. Section 7. How to buy a stock. So how do you actually buy a stock? You don't walk into Tesla's headquarters with cash. You use a broker, an online platform or app that connects you to the market. Think of your broker as your digital bridge. Popular ones include Robinhood, Fidelity, Charles Schwab, and Interactive Brokers. You open an account, deposit money, and then choose the stock you want. Most platforms now let you buy fractional shares, so even if a stock costs $2,000 a share, you can invest with as little as $10. When placing an order, you usually choose between market order, buy or sell immediately at the best current price; limit order, buy or sell only at a specific price you set. Market orders are fast, limit orders are precise. Both serve different strategies depending on how actively you want to manage your investments. Section 8. Common misconceptions. A lot of people avoid the stock market because they think it's gambling. But here's the truth. It's not. Gambling is pure chance. Investing is ownership, backed by real businesses creating real value. When you buy shares of Apple or Johnson & Johnson, you're owning part of their profits, their growth, and their innovation. Yes, markets fluctuate. Crashes happen. But over time, companies that innovate, produce, and serve real demand tend to rise. The market isn't a casino. It's a mechanism for long-term wealth transfer from emotion to discipline. Section 9. What drives the market? Fear and greed. Every headline, every chart, every spike and crash, they all trace back to two human forces: fear and greed. When people are afraid of recession, inflation, or bad news, they sell. Prices fall. When people are greedy, chasing hype or trends, they buy. Prices rise. In the short term, the market behaves like a voting machine, swayed by emotion. In the long term, it acts like a weighing machine, measuring real business value. That's why patience always outperforms panic. Section 10. Long-term strategies that work. Most millionaires didn't get rich by trading daily. They got rich by staying invested. Here's what typically works long-term. Invest consistently. Put money in regularly, like every month, through a 401k or index fund. Diversify. Don't put all your money in one company or one sector. Spread risk across industries and geographies. Hold long-term. Let compound growth do its job. Over 10 or 20 years, time beats timing. Ignore the noise. The news loves drama. Don't let headlines drive your investment decisions. Investing isn't about being right every day. It's about being consistent for years. Section 11. The global impact of markets. The stock market isn't just about individual profit. It's the pulse of global capitalism. When companies succeed, they hire more people, pay more taxes, and innovate faster. When markets crash, economies slow down, jobs are cut, and governments step in to stabilize confidence. It's all interconnected. Your 401k, corporate growth, even government budgets. That's why the stock market matters to everyone, whether you invest or not. Section 12. Risks and realities. Still, let's be honest, investing isn't risk-free. Even good companies can fall. Trends change, industries evolve. In the 1990s, Nokia and BlackBerry dominated phones. In the 2000s, it was Yahoo and MySpace. Today, they're history lessons, proof that innovation never stops. The key is not to predict winners, but to stay adaptable, diversified, and patient. Because the only guarantee in the market is change. Section 13. Closing. The power of ownership. At its core, the stock market isn't about charts or tickers. It's about ownership. It's about believing in ideas, innovation, and human progress. When you invest, you're saying, I believe the future will be better than today. And if history has taught us anything, it's that, despite setbacks, that belief has been rewarded. So the next time you hear about stocks going up or down, remember this. Behind every price is a business. Behind every share, a story. And behind every investor, a choice to stay patient, informed, and confident in the long game. Because in the end, wealth isn't built from guessing, it's built from understanding. If this helped simplify the market for you, subscribe for more clear, unbiased finance breakdowns every week. This is Finance Simplified channel, where we turn money talk into real understanding.